My guest today on Stansberry Investor says things are about to get insanely crazy, so buckle up. He says that what he's seeing today on Wall Street is stuff he's never seen in his 25-year career. So, what should we be preparing for here? Please welcome to Stansberry Investor, Frank Curzio. He is the man behind Curzio Research and the voice on the popular podcast Wall Street Unplugged. Frank, good to see you again. Welcome to Stansberry Investor.
Good to see you, and thank you for the invite. I really appreciate it. And great to be back. Thanks.
Fantastic. Well, I'm eager to get your thoughts, Frank, since it's a while since we've last spoken. I was watching or listening to your latest podcast, and I was like, wow, Frank is seriously worried here. Talk of inflation, and you say, yeah, a little inflation is great. Okay, the economy is starting to rebound, get things going, but runaway inflation is really something we should be fearing here.
Well, what did the Fed want to do? They wanted to create inflation. They've been doing it since 2007, 8, 9 during a crisis, and it was different. We came from this inflationary times and a much lower base, and everybody thought that we'd see inflation if they kept rates low, for a considerable amount of time. They wanted to keep them low for the next 6, 7, 8 years, raise them a little bit. Now they're low again. But the Fed has been used to being able to print money, and we're not seeing inflation. Today, they accomplished their goals. And if you look the last 3 weeks, and I'm not this inflation crazy guy, we haven't seen real inflation probably in about 30, 40 years, since the late 70s into the 80s. And I think that people need to understand that this is an incredible risk to the markets, because you can't print your way out of this. You actually have to do the opposite. So what has me so worried? It really is the past 2 weeks where you're seeing restaurants can't find people to hire. If you're out there, you'll see it yourselves. I went with my wife to dinner this Saturday, and 3 different places closed early because they said they didn't have enough workers. There's not enough builders to build homes. When have we seen that? Yeah, we saw that during the big rush in 2005, 6, 7. But right now, you're seeing real estate prices go through the roof, and it's crazy. But how many times have we seen plants closing because of supply shortages? So we're seeing Ford, GM, they're closing because there's so much demand. We saw UPS come out. All these companies cut. Everybody is raising prices, and now it's showing up on the key levels, because they always look at the CPI, which is a dialed back version since the Reagan years, to make sure that you never really see inflation through it. It's growing at 4.3% right now. So that's a compound average rate based on what the last month's numbers were. We're talking about 2% inflation. It's over 4% right now on the CPI. That's the gauge the Fed looks at. And they were saying, well, 2% is okay, 3%. But if you're doing a compound annual rate, it's over 4%. Core import prices up an incredible 8.6%. Wages are rising tremendously. And what do we see during inflationary times? We saw real estate prices rise, again, 2005, 6, 7. And that's definitely a huge indicator. But wage growth, we had record wage growth the month before COVID. And what happened? Well, everything was shut off, which is fine. Now you're turning everything back on, and you're handing money directly to people. This isn't like 2008 or 9 where you're shoring up the banks and making sure the banks are going to be okay and they're going to be fine. And it's more of an indicator showing that they have strength, right? So you didn't really have to spend the money, just know that they have it and they're not going under. Today's different. I mean, they're handing checks to you, to me, to everybody, to small businesses, and telling you that you don't have to pay them back. All this money is coming into the market at the same time. It's $10.5 trillion, $10.5 trillion, which is 50% of GDP, handed to these people at the exact same time, and they'd had handcuffs on from COVID, and now everybody's going out and spending like crazy. The earnings estimates are through the roof. The average company in this earnings season is beating earnings by 30%, the highest on record. You're looking at lumber, you're looking at copper, you look at just commodity prices across the board. When you see this, inflation is here. The thing that scares me, we have to worry, because now you achieved your goal, is that I don't know if the Fed sees it. I don't know. I know our politicians don't really care, right? They're just going to continue to spend money to buy votes, right? And it's on both sides. So what do we have? Well, the Fed should be slowing this up right now and saying, okay, we're going to raise rates maybe early next year. They're not going to say that. They're going to say interest rates low basically forever. They'll say 2023 and throw it out there. But they're buying bonds right now, which, puts more money to the market. We need money taken out of the market. They're not going to do that. So, when you're looking at that, and also another 2.3 trillion
Right.
whatever, maybe it's a little bit lower than that coming into the market. It's now you're pouring gasoline all over this inflation fire. And that's what has me scared. So in like 6 to 9 months from now, I think we could really see this hit the markets pretty hard.
Well, they must see the numbers. They must know, Frank. And like you said, they're keeping interest rates low. They've said they're going to keep buying bonds, like you've said. We're going to see another infrastructure package. So, what is one to do here? Do you get out of stocks? Do you look at hard assets? How do you protect yourself in this situation?
Yeah, so protect yourself. That there's numerous ways, and I'm not calling for a massive market crash here. We're going to continue to go higher during the reopen trade, and we've done very well during
Right.
this time at our business, Curzio Research. So uh, I'm not telling you to get out of the market, but I am telling you should protect yourself. I think gold, finally, we're going to see gold really surge. I think we could see 2,500 by the end of the year, which is a pretty bold forecast for someone like me. I know people have been calling 5,000, 10,000 gold since they were born in the 60s. But for me, I would buy the larger producers because these guys could produce under $1,000. And we have $1,700, $1,800 gold prices right now. But more important, these guys, their balance sheets are incredible. They're buying back stock, they're raising their dividend, and these guys are in prime position. And I would challenge anyone out there who really follows every single industry like me. I don't think you'll find a cheaper group of companies growing faster than the large cap miners right now. So even if I'm wrong and you don't see inflation, or gold prices go incredibly higher, you're still probably going to make money on these stocks. That's how great they are, and the margins are incredible, the highest they've been in the industry. I would buy long dated puts. Again, maybe hedge 5% of your portfolio. So when you do that, you're not shorting the market because you don't know this market can go up another 40% from here. We've seen that with Tesla. We've seen that with so many companies. You really don't know, and numbers don't matter right now. But you're only going to lose the money you put in. Now, all right, say if you're wrong, you lose 5%, but everything else long in your portfolio is going to go higher. Yet if everything goes lower, that 5% can represent 10, 15, 20% of your portfolio. That's how I would hedge. That's how I'm hedging, just to be on the safe side. But now's the time to hedge. It's not a time to go 100% all in. You're going to see stocks continue to do well. Again, it's just everything's there for low interest rates. The housing market's doing great. Demand is through the chart. It's through the roof. But for me, looking at this as a whole, we need to slow down, and it's painful to slow down. And I don't know if the Fed's going to do that. And for anyone out there, it's easy for us to see it real time than it is for a lot of people at the Fed because they're looking at charts and relying on data. Just go out to your local restaurants. There's restaurants in Florida. I'm in Florida. Everything's pretty much open 100% capacity for a while now. They're operating at 6% capacity because they can't find help.
Well, I want to elaborate on that point, which I find interesting because on one hand, we've had all these layoffs during the pandemic, yet we can't fill these type of jobs. Now, is it have to do because people have these stimulus checks coming in, or have they perhaps discovered outlets like Bitcoin and are thinking, hey, I could be speculating with this money and making way more money than I would, working as a waitress? Why is it hard to fill those jobs right now?
It's hard to fill those jobs because these people are making more money staying home than they are working. And now that they got the taste of staying home for such a long time, even they said surveys coming out, 25% of workers want to change a career, right? That they realize a really cool lifestyle. Okay, you don't want to be home all the time. And of course, if you have kids like I do, you're like, you need them to go back to school a little bit. But it's people are thinking about how they could better their lives. And so they're like, well, one is a lot of workers, especially in those restaurants, when you're targeting those workers in bars and stuff like that, hourly wages, it's not worth it for them because they're still getting checks. They're still getting stimulus. So
Right.
they're going to demand more money. And that's where you've seen inflation come with higher wages. And you're going to have to pay these people a lot more than $15 an hour, $20, $25 an hour. And how do they make up for that? Well, they start raising prices on the foods, all the drinks. And that's what you're seeing. And it's just right now with all this inflation, I would think the Fed would be like, okay, let's slow up a little bit. And but when I see things I haven't seen in my career, like plants actually closing because demand's too high and there's a chip shortage, there's no inventory. Inventory levels are incredibly low. This is going to last for a very long time. This is going to last for like 6 to 8 months, at least, until you could order something and get it in less than that time, which is pretty crazy.
Frank Curzio, he is the voice behind the popular podcast Wall Street Unplugged. Thanks for joining me here on Stansberry Investor, Frank.
Thanks for having me. Appreciate it.
And thanks for watching. We'll have much more for you on Stansberry Investor, so be sure to stay tuned. In the meantime, share us where you watch us. That's it for me. I'm Daniela Cambone.